Good morning, everybody, or good afternoon. Welcome to our monthly webinar on financial planning and charitable giving. Um, we hope you all had a wonderful Christmas, enjoyed it with your family and friends, and New Year's coming up very quickly. As
Oh
you
yeah.
see, we're working on interesting locations today.
Scramble.
Great. Well, my name's Daniel. I'm president of Final Frontiers. I'm basically just sitting in and learning what you guys are learning, and I'm excited about it.
My name is Michael Horn. I'm the vice president, and I'll pass it over to Scott. He'll get us taken away.
All right. Well, my name is Scott. Last name is Vigneri. Anything close that you can come up with, that's good. But today we are going to be talking about premium financing and premium funding, which could come across as way off in outer space. But there's a reason I'm talking about it. And then, but as I often say, first of all, I'm not an attorney. I'm not a CPA. And if you like any of these concepts, we recommend that you work through your advisor. And also, we are going to be talking about the gospel, and we talk about the Bible. We talk about Jesus. And so you're welcome to stay, but just so you know that we will be talking about the gospel, because that's what this is all about, finding ways to get the gospel out to more and more people. And we're talking about a tool that can help with that. So this is today's topic is a little tangential, but that is what we're talking about. So with that, go ahead, Michael. We'll start with the first slide.
All right, I think we should be up.
That's good.
All right. This young lady, I've used her for every slide, every webinar for the past, I don't know, 6 months or more, because it makes me think that God created this young lady. Most of us have no idea about anything about her. We don't know where this picture is taken. Now we do, but most people have no idea that this girl even exists. But she was created by God. God knows she exists. And by the way, God knows you exist. And many of us are facing, the holidays weren't so happy for some of us. But God is aware of all that. And God says, the Messiah says, comfort ye. And God says, come unto me, all of ye that are burdened and heavy laden, and I will give you rest. And that's what we're giving people, the knowledge of how to come to God and get that rest and that peace. It doesn't mean the problems are going to go away, but it does mean that a living God, a living Savior will be with you through all that. I wasn't planning on preaching, but I guess I got carried away there. But nonetheless, that is what this is all about. And what we're talking about in all these webinars are the tools that can help us in our own lives and help us help other people. So, next slide. Premium financing. And I apologize. Like I told them, I'm going to be doing a seminar at this building that, I don't know if you can see it behind me, and their internet went out. So I was going to be on there, but they have no internet. So I'm on my phone. But premium financing, what exactly is premium financing? And the truth is, right now, the way things are going, the better question is what it is not. There is a bit of a trend right now that there are people out there offering it as a way to get free insurance. That is not what premium financing is about. And they're marketing it and they're selling premium financing to people that, they really have no business doing that. And it's not a way to get free insurance. And it's not a way to get a bigger policy. And if you can't afford the premiums on a policy, this is not a way to afford the premiums. That is not what this is all about. And there are people out there, and that is why I'm talking about this. There are people out there offering premium finance on small policies, relatively speaking. The policies we're talking about that should be applicable are like 25 million, $100 million policies, not a $100,000 policy. Premium financing is not appropriate there. And then what happens is 99% of those cases are what use index universal life, which we talked about recently. And they don't perform. And then they have collateral calls. And then they don't have the collateral. And then they lose the policy. And that's wrong. So I just want to do this mainly to alert people out there that you do need to be careful. And unfortunately, there's many, many concepts out there like that it's a good concept, but people misuse it and take advantage of it, and it's not the right thing. So just wanted you to be aware. Anyhow, so let's move on to the next slide. Premium finance, what it is a tool for those who are purchasing large policies for estate planning reasons, including taxes or even future income. What it does is it allows a person to collateralize instead of capitalize the premiums. That allows them to use their monies elsewhere, but still be prepared for the future and the unthinkable. So let's move on to the next slide. I like this little guy. Collateral. It is the most important word or concept when it comes to premium financing. Collateral is where you put something up as support. Some of these companies will accept real estate. I have some people that own several hundred acres in a different state, and they want to buy a life insurance policy. We can use their real estate as collateral. They don't have to sell the real estate. It's just used as collateral until the loan is paid off. Why would somebody want to finance the premium on a life policy? So let's go on to the next slide. So collateral, like I said, is when you use something to back it up. You either have a brokerage account, you have real estate. In some cases, you can use a business. It all depends on the lender. Whereas if you capitalize it, that means you're paying for it out of your own pocket, dollar for dollar. Whereas if you collateralize it, the lender is paying the premiums for you, and you are using your money elsewhere. So in many cases, that's where these concepts fall apart, is in the collateral. There can be situations where there is no collateral required, but that means usually a higher cost in a longer term, or a higher rate of interest. The lenders need to see skin in the game. That's why they require collateral. Many times the client is not adequately educated as to the need for collateral, and that there could be more required in the future. And these are what they call collateral calls. And many times it comes as a surprise. And this is one of the things that gives this concept a bad name, because the agent and the lender did not take the time to educate the client. But many times when we get people who understand the concept, they go, yeah, let's do this. I can't tell you how many times that happens. Yeah, let's do this. But if you aren't educated and don't understand, you get surprised. Wait a minute, I didn't think there was supposed to be any more collateral. And the agent should have taught them, yes, there can be. And we plan this so we know where there are going to be collateral calls at this stage and at this stage. It has to be designed from the get-go. And you have to be educated on how it's going to work. So those calls won't be a surprise to you. You expect them. Some cases, they're a little less than what you anticipated. Some cases, they're a little more. But they shouldn't be a huge amount. And that's what happens in some cases. People get totally surprised by a collateral call and they get angry. And they should, because somebody didn't do their job, either the lender or the agent or both. They just think, well, this is the way, like I said, this will get you some free insurance and or help you afford it. That's not the reason to do this. Let's go on to the next slide. All right. So, for example, we have John. John is a business owner, and he sat down with his attorney for some estate planning. And in the process, his attorney suggested that he buy a $25 million life insurance policy to cover his estate taxes and care for his family, and maybe for some future income. John was reluctant to, because he's investing in some new machinery for his business, because they've just got a big contract with another international corporation to provide a product for him. So it's a big step for them. So for him to buy a policy and to fund these equipment, he can't do both. So his attorney suggested premium financing. And John was like, what does that mean? So after his attorney and an agent went over with him, John did decide that that was the best way to go. So John was able to collateralize his insurance premiums through premium financing, and then capitalize the expansion of his business. He was able to take care of his family and the business, whereas before it was an either-or situation. So here's a business owner, and he needs to buy this policy. Now the policy is going to earn interest. Typical policies, whole life is anywhere 4 to 5 to 6%. And that's guaranteed from year to year. They declare that every year. Whereas an IUL, it can fluctuate. There are caps, and we talked about that before. But they can earn 7, 8, 9%. It all depends on the market and the costs. But John, with this new concept, he is making 18 to 20% on that money. So if you're a business owner, are you going to take your money and put it into something that's earning you 5%? Or are you going to put it into something earning you 18%? But you need that life policy, because your attorney suggested that, because you want to take care of your family. Well, I would just skip the life policy. Yeah, you could do that. But when we get into these kind of situations, these people understand the value, and they understand money and how all these things work. And as soon as they learned about something like this, many of them say, let's do this. Never sit down with anything like this without your CPA or without your attorney. Get everybody involved. Get your attorney involved and get your CPA involved. Many times, these kind of concepts will come from the CPA or from the attorney. But if not, be sure your attorney's involved and be sure your CPA is involved. And if it works for you, go for it. If it doesn't, don't do it. It's as simple as that. So that's what it does. You can collateralize the premiums on your life insurance, but it needs to be a large policy. And if you have somebody, there's several marketing organizations out there, they're offering premium financing on, $100,000 policies, and you do not want to get involved with that. And then it opens up a lot of doors for other things as well. So collateralize your premiums and capitalize your business or whatever else you want to invest in. All right, let's go on to the next slide. So that was premium finance. And as the title may have said, we're talking about premium financing and premium funding. Now, what is the difference with premium funding? This is where it's going to get a little complicated here. And I'm just going to hit some of the high points, but let's go on to the next slide. All right. Premium funding uses leverage with no out-of-pocket outlay to purchase large amounts of life insurance. So your attorney says you need to buy a $25 million policy. There's premium financing or there's premium funding. You're like, what is premium funding? It uses investments. You have no out-of-pocket expenses if you use premium funding. It'll bypass the bank's capital markup. When the banks loan out capital, they mark it up so they can make a profit. But when you use premium funding, it bypasses the bank and you get that discount. It's basically getting your interest rate at a wholesale rate. That's kind of the same concept. And if you borrow this money, that money is not on your balance sheet of your business or of you. It's completely off. And that's very important. If you're a business owner, you understand the value of that, because then if you have that money borrowed, it's a liability. But if it's not on if it doesn't have to go on your books, it's not a liability. There is no interest accruing as there would be with a premium finance policy. So interest is paid by the lender on a monthly basis, nor is there any personal guarantee required by the guarantor, by the owner or the client. It utilizes what they call a direct pay letter of credit. Bank will issue, or the investment bank behind it will issue a direct pay letter of credit. That's basically a bank or somebody like Goldman Sachs or somebody like that saying, we guarantee this. It's pretty strong. It's one of the strongest things there is. It is an investment banking structure utilizing insurance for you. It is not insurance using an investment structure. It is the other way around. Now, with premium financing, the typical term is about 10 years. And they usually will set it up so the policy is a 10-year pay. Whereas with premium funding, it's usually 50 years. You can get a 50-year term. That's a long time. It is a longer process than premium financing, but it is much more powerful. A premium finance case can take usually about 3 months to set up, a little more, a little less. Whereas a premium funding can take anywhere from 6 to 9 months. But the power that it can give you is tremendous. It is a longer process, like I said. And like I said a minute ago, people who understand how money works and how all the economy works, again, 9 times out of 10, we sit down with people and they're like, where do we sign? And again, their CPA is there, their attorney is there, and their CPA is going, let's do this. I think it's a good idea. The attorney is going, let's move forward. And the client is like, yeah, let's do this. So there's some very definite benefits for people. So, like I said, people who understand how money works are very interested in this concept, and it is a longer process. So let's move to the next slide. I think that's the final slide. Yes.
It is.
Thank you for being here. This covered some very deep topic, and we did it in a relatively short amount of time. The main reason I brought up this topic, like I said, is so you are aware of what's out there and from either side. If there's people trying to sell you premium financing to make it cheaper insurance, you don't want to do that. Or find you a way to get free insurance or anything like that. That's not what this is about. But if you're a person of means and you're looking for ways to, you want to capitalize your business, but collateralize the insurance, this is something to look into. So with that in mind, if we have any questions, We might get a billion questions or 0 questions.
No questions at the moment. Definitely
No questions from me. I think this mostly applies to individuals a bit higher net worth than than me, but it is interesting to learn about, and I'm hopeful that this will be useful to someone.
Yeah. And the people who have learned about this, like I said, when they sit down and they understand how money works, boom, they're in it. They sign up almost instantly. Not everybody, I can't say everybody, but many people that take the time to sit down and go through the process. And like I said, they get their attorney involved and their CPA and their any other advisors. Um, up to 80–90% of the time, they go for it. Notwithstanding the long time that it takes, they still do it. And all the other things that have to be, all the paperwork that does, because there is a lot of paperwork, and it protects you and them, the lenders and the vendors. So, all right, well, good, no questions. I either made it crystal clear or clear as mud, and or
what happened?
I think you made it pretty. I mean, I would say you made it pretty clear because even I could understand what you were talking about. So I think that's a pretty good sign.
Well, don't be so hard on yourself there, Daniel. But I think you're a lot more astute than you're giving yourself credit for. But well,
I
good.
hope so.
Yeah. But all right, well, if there's no more questions, and I guess we'll sign off until next time.
Yep, we'll see you all in January. Have a happy new year, everyone, and pray for a blessed new year. And we'll see you later in January.
Bye.
Thank you.
Bye.